It's the Real Estate Podcast, brought to you by ANZ Home Loans for financial well-beings.
Hey, welcome back to the Real Estate Breakfast as we connect you to the largest real estate property knowledge bank. Yes, right across Australia, and we're doing it 7 days a week, streaming right now on Spotify and Amazon. Gee, the weekend is nearly here. It is a Friday, May the 16th. Perth's property market. Now, this is showing cracks with over half of its suburbs in decline, including former boom areas like Rockingham and Baldivis. Domain reported that hotspotting data reveals that 26% of suburbs show positive sales trends. Meanwhile, if you take a look at Darwin, which we did last week, that is on fire, leading the nation with a 49% spike in sales and 79% of its markets trending in an upward motion. And regional WA is a little bit on the mixed side. Geraldton is the place to be. That is shining with a 6.5% price jump. Now, this morning we are taking a look back at the Australian property market with a retro dive into February and March of last year, into 2024, and what we were talking about. So let's then go to February the 19th of 2024 and catch up with Rich Harvey in Sydney.
Craig, great to be with you again, my friend.
And last year, we were talking about those damn interest rates, just like we are talking about them today in May of 2025.
We now absolutely are assured that interest rates are going to go down. They've peaked. There's no doubt that they've peaked because we know the inflation numbers trending in the right direction. The question on everybody's lips is, when will the first rate cut come? And I can tell you now, the first 6 months of this year, I don't think we're going to get a rate cut. So that's the window of opportunity, I would say, to any potential buyer out there, knowing that rate cuts are coming. And when that comes, that'll reignite, re-stimulate the property market.
And migrants were also something that we were talking about last year.
Last year, we had almost 510,000 migrants come into this country. I mean, that's just unbelievable. We've never had that high since, I think, World War II, where that many people have come into Australian shores, which is simply just catch up from COVID times. We're expecting around over 300 to 350,000 migrants this coming year, and probably a year after that, another 250,000.
And government initiatives to build. Yes, talking about them in 2025. We were also talking about them back in February last year.
The federal government has set this target to build 1.2 million homes over the next 5 years. But if you look at the actual number of houses being built, there is no way they are going to achieve that target. Currently about 20% under the target of what we need to build. So there's going to continue to be, unfortunately, a rental stress and a rental crisis. There's going to continue to be a lot of headlines in the media. So I guess, what do you do with all that information? A lot of people throw up their hands and go, oh, it's all just too hard, I'll just keep renting. And we're seeing a lot of trends of people moving interstate, particularly chasing affordability. So areas like the Gold Coast, Brisbane, Sunshine Coast, Newcastle, Central Coast on the east coast of Australia is definitely seeing a significant uplift. And I think Brisbane is probably going to be the standout performer, as is likely to be Perth this year, simply driven by affordability. So I think people have got to just take stock of their situation and go, how do I cope with all this media information? And how can I get a strategy around buying that's going to work for my financial situation?
And no surprise that good properties sell in any year. You know, a good property is going to sell well in 1965, 75, 85, or in 2025. If you've got a great property...
The really good properties, the quality properties, they're the ones in the highest demand. It's the, B-grade substandard properties. They're the ones that typically pass in and you see there's a bit of haggling happening after the auction.
And the real estate market is built on confidence. So there is no surprise that this featured last year with our property analysis.
Look, the property market very much thrives on confidence. And if people feel confident that interest rates will come down, they'll take action accordingly, right? If they feel confident that their jobs are safe, they'll respond to that. If they feel wealthy, they'll spend more money. So the Reserve Bank is trying to do this sort of balancing act whereby they want, wages to increase, but not too fast. They want prices to increase, but not too greatly, because things can get out of whack if things just travel along at breakneck speed. So I think that the confidence factor will be an important thing to consider. But as for the property market, we all know that we have such a shortage of properties in Australia, and it's going to continue. And, quality properties located in great suburbs with, great amenities, they're the ones that will outperform the averages. But there's certainly a lot of pockets that any buyers out there could consider. If I'm an investor, I'm looking for the best capital growth and yield I can get. And there's different solutions for every investor that's out there.
Every morning from 6 a.m. across Australia, we deliver you the latest property news, commentary and predictions from Perth to Cairns and from Melbourne to Brisbane, 7 days a week.
And in March of last year, Margaret Lomas was here. She was talking about mortgage rates and shopping around for a better rate. Now, we talked about it last year, but you should be doing this in 2025.
So if you see a bank cut their fixed rates, and you need to look at what terms they're cutting it over. So banks will have fixed rates from 1 to 5 years, and there'll be a different fixed rate depending on the term that you're taking it for. It's a reliable indication that for that period of time, they expect that you will pay more interest to them on that fixed rate than you would if you stayed on variable. So if they're cutting their fixed rate for whatever period they're cutting that for, that would mean to me that they expect that during that time, the variable rates will dip lower than that fixed rate. So it's an indication of what they're thinking. If I can get a fixed rate 0.5% lower than my variable, I can expect during that fixed rate term that my variable is going to come down more than 0.5%. That's what the bank is thinking. So if I stayed on my variable, I might initially be paying that little bit more than the fixed rate, but at some point the bank's expecting the variable to come down low enough under the fixed rate so that overall the interest paid during that term is going to be less on the variable than on the fixed rate. I never ever fix a rate if they're going down low like that, unless they're so low that I can do some calculations. Quick example, when banks were cutting their fixed rates right down to below 2%, and I at the time was on about 4.5%, I worked out that I needed something like 10 interest rate cuts to beat what I already had on my variable, and it was worthwhile going the fixed at that point in time. That in my entire career investing, and it's now more than 25 years, that was the only time in 25 years that the fixed rates provided a viable option. Generally, they don't, and generally a fixed rate cut tells you mortgage rates are going down.
That is a really interesting formula to apply. I think a lot of people just don't sort of look at the machinations when it comes to all of that. Now, let's move into having a look at new builds, because it's a very sort of unfortunate situation. It's a byproduct of what has happened with COVID, and that is with so many of these builders going to the wall. New builds, of course, very attractive, but people do have to be careful.
They do have to be careful from both an owner-occupier and an investor point of view. We saw another Victorian builder go into liquidation. And unfortunately for the people who are putting up their deposits and paying the money to get their homes built, they're often significantly behind when that happens. Even if they can find someone else to finish off their home, often the amount of money they've paid so far on that build is a lot more than the build is worth, and it costs them a significant amount of money to get that build completed and to have someone else come in. So my advice to people who are buying from a builder is, first of all, if possible, try to check out their financial situation. Ask them to show you, particularly if they're a publicly listed company, all of their financial data, so you can make sure that these people are very liquid at the time that you go in. Make sure that you have a buffer built in so that if they do go into liquidation, you've you've got a way to get out of that. And try not pay too much up front. You can negotiate what you're paying as a deposit up front, so try and negotiate that as well. If you're an investor, we often see developers and big builders looking outside of the areas they're building in for investors to buy these house and land packages, and they're selling to them to these investors under the guise of being a great investment and you're going to get X amount of rent when they're finally built. A couple of words of warning here. First of all, check out what the price of that new build is in comparison to existing 2, 3, even up to 10-year-old homes, because those 2, 3 and 10-year-old homes are virtually going to be the same as this brand new build. Really, they're just a couple of years down the track. So check out what the price differential is. Often there's a real premium built in for getting that brand new home that you don't see as a return in increased equity. Whatever you pay for the house at the beginning really doesn't matter. What matters is what that house is actually worth. So the new build is only going to be worth what the other houses around it that have been there for a few years are worth. That's the true value of it. And also look at how many of these houses are being built. They might tell you can get $500, $600, $700 a week rent, and that might be the case when you're first deciding to build that property. But what happens if they build 100 of them and dilute the market to the point where you've now got more supply than demand and rents are forced down? That's the biggest problem that I've seen for investors buying a new house and land package. When it's finished, they hardly ever achieve the rents that were promised, and then they find themselves in a situation where they're not getting enough money in to cover what's going out on their mortgage and expenses, and they often have to sell prematurely at less than it cost them to build that house.
I think the underlying thing here is do not be afraid to go in really hard with your due diligence, because people can be seduced when they look at a building company and they might have 100 homes, massive. Now, we cannot look at large companies with any sort of safety nets and say, well, they're big, I feel confident that I can go with that company, because we know the big ones fall as well. So the key is to do a really hard, in-your-face due diligence and have those exit strategies that you talk about.
Absolutely. And the thing is, most people who go in, particularly owner-occupiers, it's a very emotional process. And most of them go in and have a look at that beautiful display home, which always looks better than what you can achieve at the end of the day anyway. And they decide to build, and they never ask that question about the financial security of the company. They just go ahead thinking, oh yes, big builder, they've got a house here, they're going to be okay. The other thing that often happens with these big builders as well is because they do have to have quite a number of builds going on at the one time, they employ contractors as building supervisors who then use contractors to do the work. And often, because the building companies are screwing down the contractors for the lowest price that they can get, you're getting poor work very often. And I've seen this happen time and time again. And then what happens is, because that building supervisor is supervising so many projects at the one time, he's getting or she's getting burnt out. And then we see the build time take far too long. My daughter just built a house that was meant to be done in 12 months and ended up taking almost 20 months. And the problem with that is, by the time she got to the 12 months, she'd paid 3/4 of the money, and it was an investment property for her, but she was getting no return on that and meeting interest bills and repayments on that loan just out of her own wage. So it can be a problem when the build time gets pushed out. You need a guarantee of build time, and you need in the contract a clause that insists that the builder pay you rent once they go over that build time.
Every morning from 6 a.m, we bring you the latest real estate news with diverse perspectives from leading industry experts. We deliver the most property podcasts across Australia every week. We connect you to the best real estate information across Australia. The Real Estate Podcast.